Hello again, everyone. Welcome to this bi-weekly market outlook call from Saxo. And today we are doing a very interesting topic, I would say. We're talking about gold and whether there is a Santa rally coming in gold, whether that rally could be extended into 2024 as well or not. Before we get started, I'm just going to share my slides first. Yeah, I guess you can see the slides on the screen now. I think just a word of disclaimer first. None of anything that we discuss today is not investment advice. It's purely talking about market trends at the moment. Moving along, I think this is a very interesting snapshot of what really is happening in the markets right now, where we are in terms of the sentiment, in terms of the different asset classes as well. As this shows, and as probably some of you would already know, we are currently in this risk on environment because the market obviously has been seeing a lot of disinflation reports. Inflation has been cooling down. So that is giving the market some confidence that the Fed rate hike cycle has ended. Even the Fed members themselves, in the coming out in the FOMC meeting, or even after that, the commentaries have been a little bit less hawkish. They've been talking about this wait and see mode, where the economy goes, where inflation goes from here, and then deciding what the next steps would be. But of course, it does seem like that there is a broad consensus within the members of the Fed committee that the rate hike cycle has ended. And on top of that, with the Fed rate cycle for tightening ending, there is also still soft landing hopes in the market, which obviously, I mean, we are not quite sure that is going to last. But for now, that is what it is. Markets are obviously expecting that the economic slowdown will remain extremely, measured. And then we've seen from, equities actually rallying on that. S&P is up 11% from its October lows last week. As you can see here in this table, it was up over 1%. Nasdaq is up about 14% from its lows in October. If you look at the dollar as well, the dollar has been going down. I would say, even though it is still quite hard to short the dollar because it still has a yield advantage and a carry advantage, but it has been on a steady downtrend in the past few weeks. Actually, 2 consecutive weeks of declines we've seen now in the dollar, and that's again a sign of a risk on sentiment, and a belief in the markets that the tightening cycles, not just for the Fed, for ECB, for Bank of England as well, most of the developed market central banks are at the end of their tightening cycles, and potentially the next rate moves would be a cut. Although the timing of those rate cuts is still a bit uncertain, I think the markets for now are taking relief in the fact that no more rate hikes and we are getting a soft landing. So if that kind of a rhetoric continues, and couple that up with obviously the end of the year sentiment, which usually supports again a risk on sentiment, supports equities, pushes the dollar down. That sentiment, obviously the seasonal Santa rally that we talk about, that's playing a part as well. So we are in that environment. We are likely to stay here until the end of the year, because what really needs to change to move away from this risk on sentiment would be a very sharp deterioration in the US economy, kind of moving markets' expectations away from a soft landing to a recession. But it's not going to be that drastic. And usually, markets are a better predictor of where the economy will go. And that obviously, again, suggests that at least for some time, there is room to stay in that soft landing camp before we really move to a stage where there would be bigger concerns about a recession. With that backdrop in place, let's move to our topic of the day, which is gold, as I said earlier on. So I think gold is really interesting within this backdrop as well. But generally, as of now, we've seen gold clear some critical resistance levels. On Friday, when I first started to put together these slides for this presentation today, I was actually seeing gold kind of testing the 2000 levels, and today we are already above 2010, which is a key resistance level for gold. And there's a strong, I would say, a bullish momentum in place. Suggesting that we could get an end of the year rally. We could also get more gains going into the next year. As I put in this chart here, there are some critical levels to watch, of course. 2010 has already been cleared, as I said. The next key level for gold to watch will be around the 2070 mark. So that is the level which is the high in 2022. It was the high earlier this year as well. So I think that will be really whether we can get above that or not will be the next key test for gold. But actually, why I really decided to kind of pick up this topic today for our discussion was, if you look here, because we've seen in the past 6 years gold and actually also silver, more so silver rather, they have shown some very strong returns in the month of December, in November as well, but more so in the month of December. If you see, we have seen gold actually yielding an average return of about 4% in the last 6 years in December, and silver about 7.25%. So pretty strong numbers, and then obviously that kind of leads you to think whether this December could again be the same. And again, if I go back to this is more a technical picture, more a performance related picture. But if I also go back to fundamentals, what really is driving these gains in gold? So both gold and silver actually, they've been rising over the last 1 month because of that rising speculation that the Fed rate hike cycle has ended, as we started talking about the general sentiment as well. Now, the market is also actually expecting that the Fed will start to cut rates next year. There's a full percentage rate cut priced in from, I think, June onwards. Full 25 basis points rate cut priced in from June, and one full percentage point cut. So, I mean, I would say four 25 basis points of rate cuts are priced in for 2024. So obviously markets have responded to these developments. Treasury yields have been falling, and as you can see with the chart on the right hand side here, the dollar is also sharply turning lower. Again, something we discussed at the start of the presentation, that the dollar is in a downtrend. It's now near a 3-month low. So all of those factors are pretty supportive for the gold rally to rally. Now, the big question from here really is that whether this rally is already stretched, because we've seen, some strong gains already in November, or is there more room for these precious metals to kind of extend their gains as well? So again, I think the key pivot for gold prices from here on really will be the start of the Fed rate cuts. So far, obviously, the Fed has been saying that we are in higher for longer, and we are not going to, cut rates very soon. But once we see that shift happening from the Fed, and once you see the first rate cut coming, I just wanted to kind of show also so this is a chart about, it is a chart. The black line is actually the Fed's interest rates, and the yellow line is the gold prices and how they move in tandem, especially the rally. I've marked those with the percentage changes, the rally in gold prices that comes through when the Fed rate cut cycle begins. So we've seen something of the order of 60%, 63%, and 400% as well. That was pretty long back, but about 60%, I would say, in the last two cycles that the Fed has cut rate, we've seen that kind of a rally in gold. So I think that just kind of leads us to believe that the risk reward increasingly right now is favoring gold. The best is potentially yet to come. But for that to happen, obviously, the trigger, the catalyst that is needed is that there has to be a strong conviction on Fed rate cuts in order to attract fresh demand from investors. Usually, the long only asset managers who they are huge participants in this gold market, and for now, they have been net sellers of ETFs for many months because of a high cost of carry. Now, what does that mean is that because we are in this high yield environment right now, bonds, short end bonds have also been giving us 5%. So there's this natural debate on why I should invest in a non yielding asset like gold if bonds or T bills are giving me something like 5%. But the bigger question next year really will be as yields start to go down. Now, T bills are not going to keep giving you 5%. Whatever you people have locked in is good, but yields are going to go down from here, especially as the economic conditions start to deteriorate. And that will bring the cost of carry equation shift more in favor of gold as well, which adds to the supportive factors that we already have in place. That is the expectations of Fed rate cuts and the broad weakening trend in the dollar as well. And what happens when the cost of carry really starts to deteriorate? These ETF holdings would start to go up. So this is a chart on the ETF holdings, and it shows that this year, despite the 10% gain in spot gold, so gold prices, spot gold prices are actually up 10% year to date, but ETF holdings have seen a 220 tons reduction. That's again, like I said, it's because of the cost of carry. The long only investors have not participated in this gold rally. But on the flip side, the other way to think about it is that if ETFs have been selling so much gold, then that should have normally weighed on prices. But gold is still up 10% year to date. I think there are, like I said, there have been, while yields have been a negative factor for gold, there have been a number of supportive factors, and key one there is central bank demand as well. So in 2022, central banks bought a record 1,100 tons of gold, according to the World Gold Council. And in Q1 2023, there was another 800 tons bought as well. Central banks are actually piling up gold. This is a key theme of, if you speak with a lot of us at Saxo, we often talk about our major theme in the markets of fragmentation game, where we talk about how the different countries are trying to obviously find new friends. So there's friend shoring and near shoring, but what's also happening within that fragmentation game is that many central banks across the world are trying to move away from dollar as a reserve currency. Just going back to what happened when Russia invaded Ukraine and their assets were frozen, so they could not access their reserves. So there's a general notion, among some of the major economies like China, like Saudi Arabia, which is obviously a key player in the oil market. So they all want to add to gold reserves to be able to use that just in case their USD reserves become inaccessible at some point. It's also called de-dollarization. Obviously, we are at a very starting stage of this, and de-dollarization is something which will need a concerted effort for many years to be able to see any result at all. But of course, central bank buying has been this key pillar of the fragmentation game, and that has picked up pretty strongly in 2022 and 2023 post that Russia-Ukraine invasion, and that has put a soft floor under the gold market, which has prevented the prices from responding negatively to periods of a strong dollar and also this high and rising yield environment. So despite the fact that there have been challenges for gold in this year, we've got these supportive factors as well, and that's why we've seen that 10% rally this year. But again, the question really, as I said, is going into next year. These supportive factors are likely to stay. In fact, they're likely to multiply as yields go down as well. Whereas, of course, these things that were negative this year, the potentially mostly the yields only that will start to turn as well. So there's a lot of fundamental factors that could make gold extend this rally into the next year. And of course, there are other reasons. Gold is really a go-to asset for diversification to balance the risk in your portfolio. So, we thought that the world was really moving to digital assets and crypto, but the need for physical assets continues it continues to find a place in most of the portfolios because of geopolitical risks, because of recession risks, because of fragmentation risks, because of inflation risks. If you're worried still about inflation coming back or staying above the Fed's 2% target, again, gold is the best inflation hedge there is. And the spike that we saw in December 2020, if you remember the chart that I showed up here, the 2020 slash spike that we saw here of 6.8% in gold and 16.6% in silver, that was potentially because of the risks of COVID-19, kind of the invention of the vaccine, kind of putting a lid on COVID risks, and it spooked risks of inflation rather coming back in a big way. So that's where the inflation hedging feature of gold really came into a very strong light as well. So this is obviously, gold is the ultimate safe haven, and it continues to kind of find a space in most of the portfolios as well. So if you think these are supportive factors for gold to continue its rally into the end of 2023 and even into 2024, when Fed eases up on its higher for longer message, then let's just look at what are the different ways that you can invest in gold. And before we get there, also, I think I would like to remind you that on the right hand side, somewhere on your screens, you would have an option to drop in any questions if you have about generally what the market is trading, where it is trading, and if you have any questions around that, but obviously more particularly about gold, because today's session we are talking particularly about gold. So feel free to drop your questions, and I'm sure we'll have a few minutes in the end to take them if there's anything that needs address. And of course, if not here, you can always reach out to your relationship managers as well, any of your Saxo contacts, if you have any questions about the markets, and we could get back to you on those later on as well. So yeah, talking about gold, and okay, gold miners is also something that people usually come up to us and ask us as to, gold has been rallying, but I've put some money in a gold miner ETF, and that doesn't seem to be doing as well. In fact, if you look again this year, while gold spot prices are up 10%, the ETF on gold from VanEck, on gold miners from VanEck, is actually up only 1 to 2%. So you can clearly see that black line lagging the gains in the blue line, which is the spot gold prices here on the chart as well. So why is that happening? And do we think that gold miners could catch up, or will they continue to be left out in this rally? So, our view really here is that gold mining stocks are undervalued if you look at it on an absolute basis or also on a relative basis. The most important reason why miners have not been doing well, particularly this year, is because they have cost issues. They need to control costs. As labor costs are rising, fuel costs are rising, material costs are rising, interest rates are rising. So this inflationary period, high interest period, has obviously caused some headwinds for gold miners, which has added to the cost of funding. It has added to the cost of running the business. And on top of that, there have obviously been a lot of focus on ESG, and there's been a lot of scrutiny by the investors, because of which regulatory costs have also been rising. So all of that has been weighing on the performance of gold miners. Um, and every time gold kind of rallied to $2,000, we saw this year that it came back because of the profit taking that was triggered potentially in these mining stocks as well. But again, going from here into next year, there is an expectation that funding costs could be lower. And if gold is breaking higher, like I said earlier, if ETFs could start to join in that rally as well, there'll be a broader support coming through for the mining sector, which could potentially catch up and even outperform the spot gold prices. I think it's really interesting. Mining stocks, and they provide leverage to gold prices. There's a prospect that you get rising in better dividend yields as well. But overall, I think the most attractive point right now is that the valuation for mining stocks is far more attractive compared to the spot price of gold. So again, I think there's a lot of reasons and a lot of ways to participate in this rally of gold if you think it could be extended further. But coming back to all the instruments, I said we'd be talking about instruments that you can use. They're listed here, and we will share the slides as well later on, so you can refer to them at your comfort as well. But there's a huge range of instruments that you can use to trade gold. There's obviously the spot, where you trade it as an FX pair. That you can use futures, and within futures there's a micro gold futures as well, which requires a smaller amount of principal compared to a usual futures. There's obviously ETFs that, like I said, there's gold ETFs, but there's also gold miner stocks and ETFs that could be considered as well. So I've just listed here. There's obviously, these are not recommendations. These are just some reference names for inspiration if you want to consider investing in gold. And as mentioned at the top, actually, gold has obviously been a strong December performance during the past 6 years, but silver has obviously outpaced those returns as well. Even month to date in November this year, we've seen gold delivering 1.7% returns, but silver is up over 8%. So it does suggest that, again, the last 6 years trends that we've seen, where silver has been up more than gold, again, that could extend. So obviously consider silver as well, and you could get the same instruments for silver as well. You could get the spot, which is XAG. You could get the futures, you could get the minor stocks and ETFs for silver particularly as well. And if you want to kind of have a more diversified exposure, then obviously there's those precious metal stocks and ETFs, which kind of invest across gold miners, across silver miners as well. So and silver has this added advantage that it is a 50% precious metal, but it is 50% an industrial metal as well, used in a lot of industries. And with this industrial activity picking up in China, potentially, I mean, if we could see that tactical recovery playing through in China because of all the stimulus announcements that are coming through, there are reasons to believe that industrial commodities could also do well. Also, again, industrial commodities get a lot of support from a weaker dollar as well. So there are actually even more supportive factors, fundamentally speaking, for silver than for gold. And from a valuation perspective, again, as well, I think silver is quite interesting as well. I think really the key catalyst from here for these precious metals will be the timing of the first major of the first rate cut from the Fed, and that would be the major trigger. And I mean, our view is really that gold and silver could be, really outperforming most of the other commodities in this period. So I think really an interesting space to be in, whether you want to take it as a hedge, as a diversifier, as an exposure to the Fed rate cut cycle as well. I think many reasons to kind of participate in with some exposure to gold. But yeah, I think I'll stop there. And I don't see any questions as of now. But of course, like I said earlier, please feel free to reach out through your Saxo contacts as well. And we'll be happy to answer any questions for you on gold or on the general markets as well later on. But that's it for now today. And happy trading and all the best. See you at the next session. Bye.